It's a waste to do the repeat because everybody can come. But the thing is that we have 1,000 students. So if we say we have to provide a lecture or lecture theater so that every student can get into the lecture, then we've got to do a repeat.
So you get about 300 in the first one?
Yeah, about 50 in the second one.
Not 50.
You know, like I said, they have an assignment due today. So ordinarily, we're getting 400 to 500 students.
So you get a 50% attendance rate?
Yeah, best. Yes, that works.
I tried on Wednesday.
And they replaced I did that, sorry. There, okay, I see. Don't worry, actually she did that, but I'm just trying to say that. Oops.
I'm not going to argue with you. I tried that on Wednesday. It was very well. It feels like
See, at 2 o'clock I like it, 3 o'clock.
okay, yes.
Because if you weren't highlighted, you could see somebody come out and see this.
I lecture it, so I really need the microphone. Yeah, I lecture it, so I really need the microphone. And anyway, I think I need it. I don't think I have the energy to shout anyway.
Later. Your microphone's on.
Test. Okay, good afternoon everyone. Welcome to your workshop number 10. Next week we'll be having a week break. So this is going to be an excellent opportunity for you to catch up on your studies or to revise for your exam, whatever the case might be. In terms of preparing for your exam, as you might know, this unit has changed significantly since the last time that was offered last year. You know that the content has changed and the unit team has changed as well. So in that respect, past exams are not so much relevant to you. What I will do, however, is I'll be providing a sample exam. So the sample exam gives you a good indication of the format and the level of difficulty the actual final exam is going to be. However, the tutorial questions that you've been doing throughout the trimester is an excellent indication of the type of questions that you'll be getting in the exam. So my view is that whatever that is going to be in the exam, it will be something that you've seen before. So it's not fair that we give you a question that you've never seen before. So if you've been following your studies, if you've been following the lectures, you've been following the tutorial questions, I can't imagine you have any difficulty passing the exam. Having said that, we do have a hurdle requirement in this unit, so you need 45% in the exam to pass the unit. So no matter how well you do your assignment, if you don't get at least 45% in the exam, I'm afraid that you... It's 45. It's actually 45%. Yeah. That's a great reason to celebrate, isn't it? So it's only 45%, so you just need to get 45% to pass the unit. But it's critical, so you really need to get 45%. If not, I'm afraid that I can't pass you. But it's not me who will fail or pass you, it's actually you who will fail or pass you. So it's all in your hands. I'm just doing my job. I'm just making a judgment of whether you've done enough to pass. So it's all in your hands, you decide your fate. Okay, so having said that, let's talk about today's lecture. Today we'll be talking about a potentially interesting topic, which is mergers and acquisitions. So this is a situation when a company goes and buys another company. So we'll be looking at generally merger activities, in general, an overview, a couple of features of merger acquisitions. We're going to spend the majority of our time looking at how we can actually value a merger proposal. So essentially, at the end of the day, if you think about it, a merger is an investment decision. Because what you are doing here is you are buying asset, except that in this case, the asset happens to be another firm. So it is an investment decision, so it's important that we are able to value the deal. We're able to value the proposal, therefore we can decide whether we are going to go ahead with the merger or not. After that, we're going to briefly talk about a couple of defense tactics that some companies might employ when they do not want to be taken over. So that's pretty much the agenda for today. I also got a couple of slides at the very back, like the couple of last slides that talk about the Australian regulatory framework, but I'm not sure if I have time to go through that. If I don't, I'm just going to get you to look at that in your own terms, okay? Right, so a merger, as I said, describes a situation where a company goes and buys another company by acquiring a controlling interest in that target company. Merger is also known as a takeover or an acquisition. So pretty much throughout this lecture, as well as throughout the context of this unit, when I talk about merger, is a takeover or an acquisition. So they all mean the same thing. I tend to use this term interchangeably. We also tend to make a distinction between different types of mergers. So we categorize them into three different categories. The first type of mergers, which is probably most common, is a horizontal merger. So you have a horizontal merger when the two companies, the acquiring firm and the target companies, are in the same line of business. So these are the two companies that are doing exactly the same thing. After the merger, they just become a much larger company, but they still do the same thing that they did before. A good example of a horizontal merger is when Westpac took over St. George. So that is a horizontal merger. They both banks, they provide financial services. After the merger, they just become a much bigger bank. As a matter of fact, they became the largest bank in Australia, taking over Commonwealth Bank as the largest one. So that is a horizontal merger. One underlying reason, or probably the most important reason that underlies horizontal merger is to save cost. So when you become bigger, you tend to be able to spread the fixed cost over a larger amount of production. So whether it's financial services or whether it's some sort of products that you're producing, you are able to spread that fixed cost over a larger number of outputs, therefore resulting in cost savings. So that is the most important reason underlying horizontal merger. As opposed to horizontal mergers, you have vertical mergers. Vertical mergers happens when the acquiring company and the target company belong to the same production line. What I mean by that, or should I say production process, what I mean by that is the acquiring company is acquiring either a supplier or a customer. So you move up the supply chain or you move down the supply chain. A good example of a vertical merger is when eBay took over PayPal. So that is a good example of a vertical merger. eBay is the online auction house. PayPal is a company that specializes in online payment systems. So when eBay took over PayPal, they kind of bought a supplier. Prior to that, they probably have to pay PayPal for each of the transaction that the payments go through PayPal. So because of that, they belong to the same production process, and that is an example of vertical merger. And finally, we have the last type of merger, which is a conglomerate merger. A conglomerate merger is said to take place when the two companies are in totally unrelated industries. Okay? So the two companies have nothing to do with one another at all. They belong to completely two different industries. Now, the result of a conglomerate merger is what we call a conglomerate. So by definition, a conglomerate is a company that diversifies into unrelated lines of business. You see a lot of conglomerate mergers in the 60s and 70s. So most of the mergers that took place 30 or 40 years ago are conglomerate mergers. But nowadays, you don't see them very often. Possibly because they do not prove to be very successful. Many companies, through the whole conglomerate merging process, try to say that 10 times. Many companies, when they went through all this merging process, they became too big, and it just didn't seem to work. It just didn't seem to add a lot of values. So 10, 20 years later, so in the 80s, we saw exactly the opposite. So we saw all these companies selling off all the divisions that they acquired 10 or 20 years earlier. Didn't seem to work. But some conglomerates appear to be successful, and one such example is General Electric. So you probably have heard of this company before because it's so big and because it's doing so many different things. So General Electric is an example of a conglomerate because it's involved in totally unrelated businesses. It is an energy provider, it is in healthcare, it is in media, it is in financial services, G Money, you must have heard of it. So this company does all sorts of different things, and all these different things are unrelated. Yeah. So anytime, if you have a company that have different lines of businesses involved in different industries, they are a conglomerate. Okay, so basically, three main different types of mergers: horizontal, vertical, and conglomerate. These days, the most common type of merger that you see is the first one, horizontal, because that's where the most benefits come from. The other two, now with the last one, with the conglomerate merger, which I haven't put up in there, with the last one, as I said, hasn't proved to be quite successful, so you don't tend to see them anymore. Vertical merger, we get to that in a minute, but pretty much most of the mergers that you see nowadays are horizontal. Now, you tend to see, like IPOs, like season offerings like IPOs, mergers tend to come in waves. What it means is that there will be a period of time where you see many of them, heaps and heaps of mergers, and then there will be a period of time when you don't see any. So it follows a pattern. It follows a pattern of a lot of activities followed by not so many activities, and then it picks up again. So just like the business cycle, it follows the business cycle. And it seems to follow the market index as well. So when the share market is performing well, you tend to see a lot of mergers activities. When the market is not performing so well, when it's a bit bearish, you don't tend to see a lot of merger acquisitions either. So I hope that it kind of makes sense because, as I said, merger acquisitions is essentially an investment decision because what the company is doing here is it is expanding externally. So instead of buying a piece of asset or equipment, it's just buying another firm. So companies tend to make expansion decisions when the market is doing well, when there's a lot of market confidence. When the market's in recession, the last thing that you might think of is to expand your business. So it kind of makes sense that it follows the performance of the market. Also, merger activities appear to display or exhibit industry clusterings. It means that you tend to see a lot more merger acquisitions in one industry compared to another. Well, this might be due to a number of factors. It might be due to regulation changes, might be due to technology changes. Following the deregulation of the financial system in Australia in 1984, you saw, that there was a lot of mergers. Essentially, what happened then was the smaller building societies and credit unions found it incredibly hard to compete with the banks. They found it very hard to compete with the banks, so many of them have to merge together just to find a cost advantage to compete. So as the industry, the banking industry went through the consolidation process, there was a lot of mergers. So a lot of activities happening during that period of time. So that is a good example of how an entire industry might go through the consolidation process, and therefore you tend to see a lot more merger acquisitions activities compared to another industry. In the past, up to now, using historical data, it appears that all the acquisitions tend to be initiated by the higher performing companies. So companies that are performing well tend to be making a bid to buy over other companies, which I hope you find logical as well, because when your company is doing well, performing well, share price go up, then that's when you start thinking about expanding. So whether you expand internally by investing in asset and equipment, or whether externally, that's the time to think about. If your company is not doing well, the last thing that you probably think about is to go and buy another company. I think you should think about fixing whatever problems that you have first before thinking about buying another company. But interestingly, although acquiring firms tend to have better performance before the merger, after the merger, a lot of studies have shown that the big winner out of mergers is actually the shareholders of the target company. They are the big winners because they get a premium on their shares. Whenever you want to go and buy over another company, you tend to have to pay a premium. If you just pay the market price, it's really hard to buy over another company. You tend to pay a premium, which is a price which is a lot higher than the current market price of your target company. So out of all the mergers, the target company shareholders come out as the big winner. The shareholders in the acquiring companies sometimes win, so you sometimes see an increase in the share price, but some other times they just do not get anything out of it at all. So, I mean, if you're a shareholder in a company and your company is being taken over another company, that's probably a very good scenario for you because you do get a very good return on your investment in that case. Now, in a minute, we'll be looking at different reasons for company to engage in merger acquisition activities. But essentially, when you have a merger, you are talking about a change in management. I mean, there's no reason for you to take over another company and just leave it the way it is because, you want to do something to create value. Because at the end of the day, as I said, it's an investment decision. An investment decision should only be undertaken when it has a potential to create value. So when you take over another company, there must be some source of benefit, some source of gains there. And usually the sort of gains come from some sort of restructuring, whether it's restructuring in relation to management or in the production process, there's going to be some changes. So merger allows for the management team to change, and therefore merger acquisitions are referred to as a transaction in what we call the market for corporate control. So the market for corporate control is when, the control of corporations change hand. So having said that, you can see that the existence of the market for corporate control, where one company can go and buy over another company, actually provides another incentive for managers to act in the best interest of shareholders. Because if you are not doing your job well, there is always the possibility that you will be taken over by another company. And when your company is being taken over by another company, chances are you are going to lose your job. It's unlikely that they still pay you to do the job that you did before. So the market for corporate control actually helps shareholders because it helps to make sure that managers act in the best interest of shareholders. Well, they might not be thinking about the interest of shareholders, but they might be thinking about keeping their own job. But in keeping their own job, they have to do it well so that they are not being taken over, and in the process, the interests of the managers align with the interests of the shareholders as well. So that's pretty much what I've got up there. Oops. Okay, so the main reason, whatever it is, the main reason for a merger is a financial reason. So it has to be a financial reason. And the financial reason is the merger has to lead to some sort of gain. Now, in merger acquisition, we tend to refer a lot to the term called synergy. So synergy is a term that describes a situation where the value of the combined firm, so when you combine the two firms together, they are worth more than apart, the sum of the individual companies. So if that's the case, we say that there is synergy. So you get synergy by combining two firms together. Together, they are worth more than the sum of the individual firms. There are many different sources of that synergy, which we are going to talk about. It might be economy of scales. It might be some sort of, complementary resources. We're going to talk about it. But you need to have synergy. You need to have some sort of gain to justify a merger. Now, of course, that's in theory. In practice, sometimes these things might be quite difficult to estimate, as you might appreciate, or they might be correctly estimated, but when you go ahead and take over another company, a lot of complexity might arise because you are talking about the whole business here, you're talking about two different corporate cultures, you're talking about, thousands and thousands of employees. So sometimes mergers might look pretty good on paper, but when you actually go and take over another company, it just doesn't work out the way that you expect it to. So that's why I mentioned a bit earlier that the shareholders in the acquiring companies sometimes come out of the deal with nothing at all. So they do look good on papers, but when you actually do it, it just doesn't work. Different companies tend to have different ability to realize the potential gains. Essentially, companies that are in the same industry tend to realize gain better. So this is when you have a horizontal merger, because the benefits pretty obvious, reduction in cost. Companies that have a track record tend to realize the gains better as well. Makes sense because these companies have experience. So I mean, if they've done this 10 times and they go for number 11, then it's more likely that they can be successful as opposed to a company who has never done this before and go and take over another company. So it's all logical there. Right, so in terms of describing the different reasons for a merger, we tend, again, to make a distinction between reasons that are sensible. So by sensible, I mean these are the reasons that can potentially add value. And then we talk about a couple of what we call dubious reasons for mergers. It's dubious because it might sound good, but it might not actually deliver the actual gain. So we start with the sensible one, and then we talk about the not so sensible one. Now, the first one I already mentioned is the economy of scale. So economy of scale is the reason that underlies horizontal mergers. So when you merge two companies in the same line of business, you expect to achieve some sort of cost reduction. This is achieved by sharing many common departments. For example, when you merge Westpac with St. George, you have the same accounting department, you have same top management, so same team of top management, and as a result, you can spread these costs over a larger amount of financial products and financial services, therefore resulting in some sort of cost reduction. So economy of scale is the main reason for main reason underlying horizontal merger, and that's the source of gain that is most commonly witnessed these days. So economy of scales. The reason that underlies a vertical merger is what we call the economies of vertical integration. The value of vertical integration arises from the cost savings as a result of dealing with less suppliers. So if you just imagine, if you don't own the supplier, you have to deal with many different suppliers to get whatever you want for your business. If you own the supplier, you don't have to go through that process. You don't have to negotiate. You don't involve the admin cost in doing so. Now, but as I said, it seems that the economy of vertical integration is getting harder and harder to achieve these days. It's just because a lot of companies find it a lot cheaper to outsource something to another company that specializes in that particular line of product or services. And also, why a little bit of vertical integration can add value by cutting down the admin cost, a lot of vertical integration can actually result in exactly the opposite. Now, as an example of too much vertical integration, think about the situations where, let's say, Coles and Woolworths, they might have to start buying farmland to raise, cows and pigs and grow vegetables so that they have their products on the shelf. So if you think about that situation, you know that vertical integration has gone too far, because you don't really need to do that. You really don't need to raise your own, animals or cattle or, grow your own vegetables to sell them. So just a little bit of integration, a little bit of vertical integration can be beneficial in terms of the cost savings, but too much of it is not going to work. It's exactly the opposite. Then you start incurring a lot more cost just because you are doing something that you don't have a competitive advantage in. Another reason, sensible, that explain a lot of mergers is the fact that the acquiring company is after something in the target company that can help their strategic directions. As an example, recently, Hewlett and Packard, which is the computer company, they took over a smaller company that specialized in doing software security. So that is one strategy for them to expand into that area. So they want to expand into software, and it might be a lot easier to buy over another company that is already in the market than trying to reinvent the wheel themselves. Or a smaller company might have an excellent product, but they don't have the expertise in marketing the product. So if it's being taken over by a larger company that has a lot of marketing expertise, it might help the smaller company to market the product to consumers. So, sometimes they fill the missing ingredients in one another. So the target company or the acquiring company might have, whether it's a tangible asset or whether it's an intangible asset, but they might have the resources that the other company wants. So in that sense, they complement each other and they create value that way. I just gave you an example about Hewlett and Packard. So they want to expand into software. So they want expertise in software. So that's why they took over that smaller company, software security, so that you've got all these people, all the programmers there, instead of trying to hire them all and rewrite all those software programs. No, yeah, I mean I don't know a lot about IT, so I don't try to pretend that I know all about software securities. But yeah, that's an example of how that can be done. Right. So I think I skipped one slide, didn't I? Yeah, so I skipped that one. And the last reason, which is sensible, is with this one, it can be sensible, it can be not sensible, depending on how well this is done. But this argument, so this is the argument. The argument is sometimes you should go and take over another company just because you have the money to do so. Now, in reality, there's a lot of companies that are well established, they are very mature, they are cash cows, they have a good product, they have a good customer base, but they have very little growth opportunities. And the example that I can think of is the tobacco industry. So if you are a cigarette producer, you have a good customer base. You've got all these smokers that are addicted to smoking and they can't quit. So you have a good customer base, you make a lot of money out of selling this product, but you don't have a lot of investment opportunities. Where do you invest? obviously everyone's trying to quit, so there's no point for you to, to invest in new plant and equipment to produce more tobacco, because it's not going to happen. It's a dying industry, pretty much. So these companies, they have a lot of money sitting there. Now, you'll probably tell me, okay, if you have a lot of money, then why don't you pay out to the shareholders? Because this money essentially belongs to the shareholders, right? But a lot of managers might not want to do that, because other things being equal, they want more control, more resources compared to less. So they don't want to shrink their empire. They want it to be bigger as opposed to smaller. So one sensible thing for them to do is just to, external expansion, go and buy another company. Because internal expansion is not possible because they don't have any investment opportunities. But externally, the sky's the limit. They can go and buy another company so they can expand externally. So that is another reason for mergers as a use of surplus fund. So you have all the free cash flows there, you should go and buy another company. However, as I said, whether it's a good reason or a bad reason really depends on how they spend the money. If the merger is a good one that can potentially deliver values, then that's okay. But if they just spend the money for the sake of spending the money, then it can be a bit of a worry, because if it's a negative NPV thing, then it might actually hurt the shareholders. Now, as opposed to that, now the problem is if you have a lot of money and you don't do something with it, whether pay it out or whether go and buy another company to spend it, then you can be a target for takeover, because money is valuable. Financial slack is valuable. We want the money because money is the thing that can be invested in whatever you want to invest in. So if the company is a cash cow and is not doing something sensible with the money, then it will become a takeover target. So it works both ways here. You have money, you can go and expand by another company. If you don't, you might be taken over yourself, because other companies view the free cash flows as valuable and they want access to that free cash flow by taking over this company. Okay, so so we've talked about the sensible reasons for mergers. So they are the reasons, or they are the source of potential gains in mergers. There are other reasons that sound pretty good, but when you think about it, it might not deliver any real gain at all. So we're going to look at two of them, and the first one is diversification. Diversification is the main argument that is used in all conglomerate mergers. So when a company go and buy another company which is in a totally unrelated industry, they are arguing that the reason they want to do that is to diversify and therefore achieve risk reduction. Because that with diversification you can always reduce your risk, because because the return of one business department might be negatively correlated with the return of another business department, and therefore if you look at the standard deviation altogether, you see a lower standard deviation. So this is the basic argument for diversification. You should diversify, you should not put all your eggs in the same basket because you want to reduce your risk. Okay, that sounds pretty good. So companies say, okay, I want to expand, I want to be involved in different industries so that there's less risk, less standard deviation. But the problem is the companies can actually diversify more dearly than the shareholders. Now, if you are the shareholders in a well-diversified, is there a problem? No? Everyone's okay? Okay, good. So if you are the shareholder in a well-diversified company, think about this. If the company wants to diversify, right, it has to go and buy another company. And as I said, when you go and buy another company, you have to pay a premium. Because if you don't pay a premium, you are not likely to get it. Usually, you pay a premium. So it's quite expensive in the sense that you are paying a price which is a lot higher than the market price to get that company. Can you do it more cheaply from your personal account? Can you, so if you want a bank and plus an energy provider, Is it more cheaply for you to go a share in a bank and then a share in another energy provider as opposed to a bank go and buy over another energy company? So as a matter of fact, shareholders can diversify a lot more cheaply than the company can. Because when the company wants to diversify, they end up paying a lot of premium, so it's a lot more expensive. So if shareholders can actually diversify more cheaply, so why does the company have to diversify? Because it's a lot more expensive exercise for them. So because of this, because the fact that diversification at the corporate level is very expensive, it hasn't worked very well. That's why you see the opposite of conglomerate mergers. You see the selling off of assets, you see divestiture, all these companies being spun off. So diversifications, although sounds pretty good, is actually not a source of value creation because companies diversify a lot more expensively compared to what shareholders can. Yes, of course you can. I'm not sure if I can answer though.
What kind of companies just buy a large portion of the share of another company and effectively control the company instead of just buying over? So say you buy 50% share of that company.
When you buy the majority of share in another company, you are effectively taking over that company. So that's what I mean.
Okay.
Yeah. So usually, I mean it depends, but most companies would have so commonly 80%. So if you can acquire 80% of the shares in another company, you are effectively taking over the control of that particular company.
To your point, you could go invest in 5 companies and 20% in each of those companies, just as investing decision. So,
as a corporation or as an individual?
As a corporation. As a corporation, to avoid having to go through the whole effort of buying the whole company, you just invest up to 20%.
In 20%. But why would you want to do that?
To say you go through the whole effort of a merger with the complications and risk.
No, but the problem is when you take over another company, you want control. Because you want control so that you can implement changes that can deliver the increase in value.
Particularly with the question of diversification, I think that was the point.
If you want to diversify, if the corporate agenda was to diversify, you could divert an alternative way of diversifying is instead of buying the whole company, the whole entity, you buy up to 20% in several different entities.
But I mean,
still
if
achieve the means of diversification.
But in
Yes.
doing that, the corporation would be pushing up the share price of those other companies.
Yeah.
And therefore it would be more expensive.
And also the problem is, if I'm the shareholder in a company that wants to diversify by buying 20% of 5 different companies, I would be very concerned because that's not what they're supposed to do. They're not supposed to do that. They should really be doing what they're doing best. They should not achieve diversification by, so that's the point. So that's settled. So the other reason, so apart from diversification, which is a very dubious reason for diversification, the other reason is by merging 2 different companies, you can sometimes see a higher earning per share. Now, the problem is, whenever you look at earning per share, or whenever you look at the share price of a company, there's 2 factors that come into play here. You look at the earning per share, but you also need to look at what we call the price-earning ratio. Okay, so the earning per share is how much earnings of the company that you are entitled to as a result of holding 1 share. So that earning per share obviously determines the value of the share because other things being equal, the higher the earnings per share, the more valuable the share is because that's the earnings that you are entitled to. That's why more profitable firms should be valued more highly compared to a less profitable firm. Now, but that's not the end of the story because earning per share alone doesn't determine the share price. There's the other factor that determines the share price as well, which is the price-earning ratio. The price-earning ratio pretty much tells you how fast investors expect the earning per share to grow. In other words, the price-earning ratio explains or gives an indication of how fast the company is going to grow as a whole. Because the only reason that you pay more highly for one company other than other, given that they have the same price-earning given that they have the same earning per share, is the fact that you expect that particular company to go a lot quicker and therefore have a better increase in the share price. So that's the only reason. So two factors that come in play here. You have the earning per share, but you also have the price-earning ratio. So back to this argument, what this is saying is, by merging two companies, sometimes you see an increase in earning per share. Now, if the earning per share comes from something real, from some real source of gain, like if the combined company is worth more than the individual companies, then that's fine. But if the earning per share increases at the expense of the price-earning ratio, then it's a dubious reason for merger acquisitions, because no real gain has been created here. You get higher earning per share, but your price-earning ratio has declined. So high earning per share, but the rate of growth has declined. So I guess with this one, it's probably best if we look at a numerical example, which is on the next slide. Okay, so what we've got is we've got two companies here. Guar Enterprises is actually the bidding company, so it's the acquirer. And Mark and Slurry is the target company. So this is the situation. So if you look at the first two columns, these are the situations before the merger. Both of these companies have the same earning per share, but they have different price-earning ratios. And that explains why the share price of Guar Enterprises is twice as much as that of Marks and Slurry. So they have the same earning per shares, but investors is expecting this company to grow a lot more quickly. In other words, investors expect that, in the future, the share price of this probably go up a lot more quickly than the other one. They each have 100,000 of shares outstanding. Both of them have total earnings of 200,000 because they have the same number of shares and same earning per share. But they have different total market value because this company here, the acquiring company, Guar Enterprises, have a better price-earning ratio. Okay, so now they merge together. We are assuming, so what I'm illustrating to you here is I'm assuming that there's no real gain. So the market price of the combined company is essentially the sum of these two companies. So, okay, but although the market price didn't change, you see an increase in earning per share. Okay, so how does it work? Okay, we put them together. The total earning is $400,000. Obviously, because now we have two firms, each of them produce $200,000. Now, in this particular situation, the way that Guar Enterprises finance the takeover is by a stock offer or a share offer. Essentially, for each share in Mark and Slurry, they pay 0.5 share in the combined company. Which makes sense because the share price in this company are twice as much as the share price in this one. So that means that you need 2 shares in Mark and Slurry to get 1 new share in the combined company. Okay? So that means that to take over the 100,000 shares here, you issue 50,000 shares in the combined company to buy them over. So the result is you had 150,000 shares outstanding. Because you've got 100,000 to start with, you issue another 50,000 to buy over this company, you end up with 150,000. Okay? Now, you've got an earnings of $400,000, you have 150,000 shares outstanding, so your earning per share is $2.67 because it's 400,000 divided by 150. Okay, so that's your total earnings divided by your total number of shares outstanding. So it's $2.67. The share price stayed the same, but look at what happened to the price-earning ratio. It has gone down to 15. So, although there has been an increase in earning per share, this should not be a real source of gain for this merger because this earning per share here has gone up at the expense of a lower price-earning ratio. So no real gain has been created here. So the point is, if you have a high earning per share, but if you still have a price earning of $20, then it's great. Then, yeah, real gain. There has been something wonderful happening there. But with this situation, you don't have real gains. All you've got is a high earning per share at the expense of a lower price earning ratio. So if that's the case, it's not a good reason for, for the merge, because essentially this is like an illusion. You've got better earning per share but lower price earning ratio. So you really need to analyze the cost of the increase. You just can't look at the increase in the earning per share as it is. You need to look a bit further. What happened to the price earning ratio? Is there any real gain, or is it just a paper, an illusion? So the increase in earning per share that I just illustrate is referred to as the bootstrap effect. It's the bootstrap effect because essentially you have a higher earning per share just because you take over another company with lower price earning ratio. That's why. This is a graphical representation of what we've been talking about. You've got war enterprises. They are growing a lot faster, therefore you have a much steeper slope. And then you've got muck and slurry, which is not growing as fast, therefore, the earnings is a bit flat. So this is, so the slope of this line demonstrates the rate of growth. So this one is not growing very fast, it's quite flat. By merging the two firms, what you are getting is you are averaging out the rate of growth. Essentially, that's what it is. So high earning per share, but lower growth. Okay, do you want a 5 minutes break before we look at merger evaluation? 5 minutes, and then we do a bit of calculation.
sorry, just a doubt in this part that, for example, price earning ratio is was greater of word and was less of muscle story. So do you think if PE ratio goes up, that is more good, or it should go down? Because even if you see the line,
I think other things being equal,
other things
the
being equal,
higher
the better.
because
Yeah.
it means that because the earnings growing at a much faster rate.
Much faster. And in this case, there is loss of word enterprise because here after merger,
They do not lose anything. They do not gain anything.
even gain anything either. But if you see this, same thing after this is turned down into 50. So you don't think there is any loss? Do you think there is any loss of EPS? Tutorials is enough, even our final test question, testing all those drivers. It is enough to get good marks in very Thank you very much.
Okay, everyone. Okay, everyone. I hate to interrupt your interesting discussions, but I think we have to get back to this so that we can get out of here. All right, so we've said a lot about merger acquisition. So now it gets down to evaluating a potential merger. So at the end of the day, as I said, we have to be able to value a proposal to see whether it can, it's worth going ahead or not. And as you probably have guessed, we are going to use NPV. So what we're going to do here is we're trying to work out the NPV of a merger, a potential merger, and of course, if the NPV is greater than 0, we're going to go ahead with the merger. If it's not greater than 0, then it's destroying value, and there's no point going ahead with the merger. The NPV in this situation should be interpreted the same way as you have always been interpreting NPV. It represents the dollar amount that is going to add to shareholders' wealth as a result of the merger. So one thing which is essential or key to a potential merger is the expected gain. What do you get out of it? Now, as I said, we tend to talk about synergy a lot. So it's all about estimating that synergy. How much better the combined company is going to be as opposed to some of the two individual companies. So it's all about, so in estimating the gain from the merger, it's all about estimating the synergy that will arise from combining the two firms. So there are a couple of things that you have to consider. Is there an overall economic gain? Do that make the company, the acquiring company shareholders better off? Is there any synergy? Okay, so if you want to put in a formula, the gain from a merger is the value of the combined firm take away the sum of the individual companies, where A is the acquiring company and B is the target company. So the difference represents the gain from the merger or the synergy from the merger. Now, of course, in reality, this is an extremely complicated exercise to be able to work out the gain from a merger. So you have to identify the source of the gain and try to quantify that gain. So it's an incredibly difficult exercise. Well, but fortunately for you, in the context of this unit, we usually give you enough information for you to be able to work out the expected gain from a potential merger. Okay, now, but the gain is one important factor that determines your NPV, but there's also the other important factor, which is the cost of the merger. Now, when I talk about the cost, I do not talk about just how much you pay to take over the other company, but it's rather the premium that you have to pay. So the net cost is how much beyond the current market value of the target company that you have to pay. How much extra that you have to pay to get the company. So the net cost of a merger is the premium that you have to pay to the target company shareholders. To make matters a little bit more complicated, there are different ways in which a merger can be settled. In particular, there are three main ways that you can actually pay for a merger. The first one, which also probably the most straightforward one, is a cash offer. So in a cash offer, the bidding company just pay cash for those shares in the target company, just straight cash. The second method is when they issue shares in the new company that are used to finance the merger. And of course, as you guessed, there will be a combination. So there'll be a combination of cash and shares that are used to finance the merger. So it might be, okay, for each of the share in the target company, we offer you $2 plus 0.15 share in the new company. So it might be something like that. So we have to be able to work out the value of each of these potential merger using different types of payment. But we will only be focusing on the first two, so we just look at when it's a cash offer or a stock offer. We are not going to look at the last one, which is a combination. Okay, so how to estimate the cost? Other things being equal, if it's a cash offer, it's a lot more straightforward. So it's a lot more straightforward to work out the cost if it is a cash offer. Also, if it's a cash offer, if it's a cash offer, then the cost is not impacted upon by the potential gain because it's just paid cash. So no matter how much you gain from the merger, it doesn't have an impact on the cost. But when you actually issue shares in the new combined company to finance for the purchase, then the cost to you is being impacted upon by the gain as well. Because as you can imagine, when you issue shares, essentially you are issuing shares in the new company, combined company, because the target company shareholders now become the shareholders in the new company as well. So the value of the share in the new company would be the value of the combined firm, which is impacted by the gain that can potentially be produced as a result of the merger. Okay? So if it's a cash offer, the gain doesn't impact the cost. But if it's a share offer, the potential gain that you calculated in step number 1 actually has an impact on the cost. And as a result, if it's a stock offer or stock bid, the calculation is a little bit more complicated than a cash offer. In either case, if it's a cash offer, the cost to you is what you pay, which is the cash paid, whatever you pay, take away the present value of the target company, the present value of the company. So as you can see when you look at this, essentially the cost here represents the premium, how much extra and above the market price that you have to pay for company B. Now, if it's a stock offer, the cost is worked out as follows. X, which is the proportion of the new company that has been offered to the target company. So the proportion here. So you have to be able to work out the proportion of the combined new company that you have used to finance the merger. So the first component here shows you how much you paid for the target company. And of course, the present value of B tells you the current market value of company B. So the difference, once again, represents the premium. Okay? And guess what? Most of the time, the cost would turn out to be positive, because if not positive, it's unlikely that you can take over the target company. Okay, so that's the formula. Finally, once you've got the gain and the cost, you can work out the NPV, which is the difference between what you gain from it, what you get out of it, and what you have to pay to get it. So the NPV is just the gain minus the cost. And if it's greater than 0, it's a good merger. If it's not, or it's not. Sorry, therefore you do not go ahead with the merger. Okay, and what is a better way of illustrating all this than by looking at an example? So I've got an example here, and we try to look at this together. Okay, so I have two companies here. A is the bidding company, so this is the acquirer, and B is the target company. Firm A has 1 million shares outstanding, each of them selling for $200, therefore the firm value is 200 million, and firm B, $100 per share, 500,000 of them, so it's 50 million, the value of the company. Now, if you merge the two firms, you would achieve a cost savings of 25 million. You have to estimate the gain, the cost, the NPV, and the post-merger share price under the two scenarios. When you have a cash offer, $130 per share, and second, when you have a stock offer, and the stock offer is for each share in company B, they will get 0.65 shares in the new company. Okay? Right, so let's have a look at this. Okay, can someone tell me what the gain from the merger is? 25 millions? The gain in this case is quite straightforward. It is 25 millions because it comes in the form of cost savings, so 25 millions. Okay, so it's 25 million. It's given in the question. You don't even have to estimate it. What is the cost of the merger? Now the cost here, remember that currently the stock price of firm B is $100. So that's the market price. But firm A has offered $130 per share. So they've offered a premium of $30 per share. So the cost would be the total premium. But I mean, it doesn't matter how you work this out. But if I'm just going to apply the formula to be consistent. But of course, if you want to work this out any otherwise, that can give me a premium. That's fine. So the cost of the merger is you pay $130 per share. There's 500,000 of them, so you paid about $65 million for the company. And the present value of B is, of course, 50 million, so the cost is 15 million, which is the premium. Okay, so I hope that up to this point it has been quite straightforward. So again, the cost. And of course, the NPV is the difference between the two. So far so good? Okay, 10 million. So as I said, when you have a cash offer, the calculation is a lot more straightforward than when you have a stock offer. The last thing that we have to work out in relation to the cash offer is what the stock price after the merger is, given that all the gain will be realized, given that we're going to get 25 million worth of cost reductions. Now, okay, so essentially the stock price after the merger would be the value of the combined company divided by the number of shares outstanding. So that's what it is. So it's PV Can someone tell me what the value of the combined firm is going to be? $260. How do you work that out? Plus 10, which is the NPV. Not really. Hmm? Okay, so now think about this. You've got company A is what 200 million. You've got company B is what 50 million. You're putting them together. You create 25 million worth of cost savings, right? So it's 200 million plus 50 plus 25. But you paid 65, right? You paid 65 out of your company, okay? So the firm value has to be 200 plus 50, so that's firm A, firm B, plus the gain, which is 25, take away whatever you have paid, which is 65. Does that make sense? Because the 65 has to come from somewhere. So the 65 million has to come from the combined value of the firm, so you have to take it out of the equation. And of course, the number of shares would be still 1 million because you paid by cash, so you didn't have to issue any additional share. So 1 million. So everything is in million at the moment, so I just divide by 1. Everything's in million. Okay, so that's 210 divided by 1, which is $210. Now, the other way that you can think about this is the NPV, which has already taken into account the cost, is 10 millions. It means that if you are the existing shareholders of company A, the net gain to you after taking into account the cost is 10 million, right? So the other way to work this out is just the present value of company A plus the NPV divided by the number of shares outstanding, which gives you the exact same result anyway. So it's up to you how you want to do it, but yeah, I don't know if this makes sense, then just do this. The value of the combined company divided by the number of shares outstanding. Okay, so that is a cash offer. What happens if you actually have a stock offer? And in this case, the stock offer is 0.65 share for every share in company B. Now, if it's a stock offer, the gain is not going to change. The gain is still at 25 million, so it doesn't change. But the cost to the offer is going to change. And as I said, the cost of the offer is being impacted upon by the gain, which is the 25 millions. Now, in order for us to work this out, we have to work out the proportion of the new company that we have offered to company B. So in order for us to work that out, we need to figure out how many shares we need to issue to pay for B. So how many shares do we pay for B here in this case? How do you work that out? How do you work that out?
0.65 times 500k.
Yes, correct. Okay, we have to pay 0.65 share for every one existing share in B. They have 500,000 shares outstanding, so the number of shares that we have to offer them is 0.65 times 500,000. Okay, so to start with, we have 1 million. We issue 325,000 more, so now altogether we have 1.325 million shares. So we've got 1 million. Now, the reason that I want to work out the total number of shares outstanding is so that I can work out the proportion in the new company that we offered B. Because that proportion is essentially that number, 225,000, divided by the total number of shares outstanding after the merger. Okay, so the fraction of the new company that we have offered B is 325,000. Okay, so we paid about almost a quarter of the shares out to company B. Okay, so now once that we've got this number, which is the proportion of the combined company that we have offered to company B, we can apply our formula to work out the cost. So the cost of the merger is, so that's the formula, X that's our formula. Now X in this case is 0.2453. What's the present value of AB here? Is A plus B plus the gain. Now remember in this case, because we don't pay any cash out, we don't have to take anything off that value. Whereas previously, we paid 65 million in cash, that's why we have to take that away from the combined value. Okay, so that is the value of A, that is the value of B, and that is the gain. Now, because the gain comes in the equation here, that's why I said that the gain, whenever you offer stock, the gain has an impact on the cost as well, because it's part of the equation. Okay, so if you just punch all these numbers in your calculator, I hope that you get you get 17.46.
453.
So 45?
453.
Okay.
It just depends on how much rounding you use, I guess.
To keep you happy, I'm happy to go with 45. So 45? Yeah. Does it make you a bit happier? Yep. 17.45. Okay. Okay, so now that everyone is happy, we can go to the next step. Okay, so I hope that you're happy with 17.45. We can go to the next step to work out the NPV of this whole thing. Okay, so the NPV is, again, gain minus cost. Okay, so NPV is 7.55 million, and the last thing that we have to do is we try to figure out what the share price is going to be after the merger. Now, hopefully, it becomes easy now, because what it is just the present value or the value of the combined firm divided by the number of shares outstanding. Okay, so it's PVAB. We have already worked out the PVAB in the previous step. It's 275 million. And the number of shares, of course, is 1325000, which worked out to be 207.55. $. Now, you know that this is the correct answer because the NPV here is 7.55. So what it means is that for the existing shareholders of company A, as a result of the merger, they get a net gain of 7.55 million. There's a million of them, so as a result, the share price afterwards has to go up by, 7.55 million, meaning $7.55 for each of the share. So that's why everything looks good. Okay, very quickly, so that's the first example. So that gives you a bit of a flavor of what you have to do in relation to evaluation of a potential merger. Estimate the gain, estimate the cost, work out the NPV. But of course, when it's a stock offer, you have to be a little bit careful because you have to work out the number of stocks that you offer to the target company, and then you have to work out the cost, the proportion, and so on and so on. So with these things, you just have to do a lot of practice to, you know, to really get the hang of it. I have another example here, but I do have the solutions right after. So possibly I'm just going to get you to look at that in your own time because, you know, if I go through it, it's going to be really boring. I would go, this is the gain, this is the cost, so on and so on. So I leave you to look through that. I guess I briefly mentioned this. Some mergers look really good on paper. So you do all the number crunching, you work out fantastic NPV, but sometimes it can be really difficult to realize that gain or realize that NPV just because of many real-life complexities. You know, different in corporate structures, different way that people do businesses. Key people in the target company might get upset by the new management, they might leave. So all those things might be attributable to the fact that many of the gains that look good on paper can actually not be realized in reality. Most of the mergers are friendly, so most of them, everyone's happy, you know, the acquiring company make an offer, the target company is happy with that, you know, good premium, everyone's happy. But not all of them are friendly, and as a matter of fact, it is the hostile takeovers that tend to receive a lot of attention. So when they are hostile, there's a lot of things that can take place. You know, the acquiring company might have to make multiple offers, so they have to probably keep increasing the offers to make the target companies, you know, to make the target company accept the offer. The target company can engage in a lot of activities or they can use a lot of tactics to try to block the takeover from taking place. So we are going to look at an example, which is the case that took place probably a couple of years ago between Oracle and PeopleSoft. That was a very hostile takeover, and that took and it took them probably about 18 months to take over PeopleSoft. But eventually it was a happy ending. They took it over. But yeah, I tell you the story. Okay, so this is the story. Oracle, as you might know, is a market leader in databases. So the student management system that we use at Deakin called Callista, I don't know whether you know, it's called Callista. Callista runs on Oracle applications. So basically it's specialized in databases. In 2003, it made an offer for PeopleSoft, which is also a software company that is specializing in also the human resources programs. So this is a horizontal takeover. So they both are in software, they're both doing the same sort of thing. Now, usually in IT, hostile takeovers are very, very uncommon. They are uncommon because in the high-tech industries, the value of the business comes from intangible assets, things like softwares, human capital, you know, that sort of thing. So they are quite rare. But in this case, the market was really surprised when Oracle said that they are going to make a bid for PeopleSoft. It was completely unexpected. So no one expected this to happen. So when the offer was made, PeopleSoft was very angry for two reasons. The first reason is they thought that the offer is too low, represented only 6% premium on the current stock price. The second reason, which is probably more important, was that before Oracle made the offer, PeopleSoft were planning to merge with another company. So PeopleSoft were actually planning to take over a smaller company. So when this all happened. So they were very angry about that, and they actually immediately launched a lawsuit claiming that Oracle engaged in unfair trade practices because they know that they were going to take over the smaller company when they announced all this. So in order to stop Oracle from taking over the company, the board of directors of PeopleSoft engaged in a number of tactics. So they did the following. First of all, they have what we call a poison pill. So a poison pill is an option for PeopleSoft to issue a lot more shares when Oracle can get control of the 20% of the shares in PeopleSoft. So essentially, the poison pill allows PeopleSoft to issue a lot more shares to the existing shareholders at half the market price. So you can imagine how attractive it is. Half the market price, existing shareholders can increase their shareholding significantly. Now, I hope that you understand how the poison pill can help block a potential takeover. Because when there are more shares in the market, you have dilution. Therefore, it makes it a lot more difficult for Oracle to obtain a majority shareholding in PeopleSoft. So that's the first thing that they do. The second thing that they have in place is what we call a staggered vote. It means that for every meeting, for every annual meeting, only a certain number of directors can be re-elected. So that means that if you want to replace the board of directors, it's going to take a number of meetings for you to do that, because not all the directors can be replaced at the same time. They do this, they have this because they're afraid that Oracle is going to engage in what we call a proxy fight. A proxy is an option to vote on a shareholder's behalf. So if Oracles can get enough proxies, which is the approval of enough shareholders, then they can potentially vote for a new board of directors. They can. But because the board is staggered, in any annual meeting there's only one or two are up for re-election. So even if they have a proxy fight, it's going to take them a couple of annual meetings for the whole board of directors to be replaced. The third thing that they have in place, which potentially aims to block this deal as well, is a customer assurance program. So in this program, PeopleSoft said that any acquirer, if they lower the level of standard of customer support, then all the customers are entitled to a full refund. Okay, so if Oracle takes over, lower the standard, then Oracle is liable to pay the full refund to all these customers. So those are the three tactics that PeopleSoft used to try to stop Oracle from advancing. Now, apart from all that, Oracle also met with a lot of resistance from the law. Essentially, all mergers, when they are proposed, they have to go through some sort of review to ensure that there is no anti-competition problem here, which they call antitrust in the US. So, because any merger that can potentially result in a reduced level of competition is hurtful to customers and is not going to be allowed to go ahead.
Does that just depend on the actual market share of the respective companies that are getting taken over? If it's not actually that big, it's really insignificant to be able to see. It's not anti-competitive.
Exactly. So there will be a body that review all that. But in this case, the Department of Justice actually believes that by combining these two firms, there might be a competition issue. So they actually file a lawsuit, an antitrust lawsuit as they call it, and the ruling is it is going to be anti-competition, but usually that's enough to kill the deal. But Oracle is really persistent. They actually appealed the decision and they were successful. So it's a very, very long story, but they were successful. In the process, they made multiple offers, as you can see. So they started off with $16 per share. They increased it to $19.50 just 2 weeks after that. And then they raised it to $26 per share, and it's a huge jump from $16 to $26. Okay, and then they actually dropped it to $21 per share, citing the fact that the market price of PeopleSoft at that point in time has dropped significantly. So all this lawsuit obviously doesn't do PeopleSoft any good, because the market's a bit uncertain about how these things will pan out, and therefore there's less demand, there's a drop in the share price. Anyhow, once Oracle won the appeal, the majority of the shareholders in PeopleSoft then just got tired of the whole thing and they wanted to sell. They also wanted to sell because the offer represents a very good premium. if you think about it, because started out, so the market share price at this point in time when the offer was first made is probably about $15. And then, you know, the offer went up significantly. So about at this point in time, probably is at about a year and a half, almost a year and a half into the whole proceeding, about 61% of the shareholders of PeopleSoft are actually happy to sell. And at that point in time, the management of PeopleSoft is under a lot of pressure, because if they don't agree with the deal, then it might be because they are just, you know, trying to protect their job. They're not acting in the best interest of shareholders because the offer sounds pretty good. So eventually they give in and they say that if Oracle can increase the offer from $24, they are going to accept the offer. Oracle did. They raised it to $26.50 a share, and the merger went ahead. So out of the whole thing here, out of the whole lengthy story, you can see that the people who come out, the winner, is actually the shareholders of PeopleSoft, because in 18 months, the share price have gone up from about $15 to $26.50. So they come out the big winner. But this story illustrates how a takeover can be quite hostile. Apart from merger acquisitions, which are obviously the obvious way to take over the control of another company, there are other methods that can be used to take over the control of another company. One of them is a proxy contest. I briefly illustrated that. A proxy contest is when you go and try to persuade the existing shareholders to give you the right to vote on their behalf. So when you have enough proxy, you have a potential to change the directors. But proxy fight is very expensive. Try and imagine you have to persuade so many different shareholders. It's expensive, it's lengthy, and it's unlikely to be successful. You've got M&A, merger acquisitions, obviously. We're going to talk about leverage buyout, not next week, but the week after, because we have a break. And of course, you have management buyout. So all these different methods can be used to acquire the control in a new company. And just to briefly, the last thing that I would like to go through is I would like to go through a number of takeover defenses that the target company can use to stop a takeover from taking place. Now, there are a number of reasons why the management team of the target company does not want to be taken over. Now, sometimes they reject a deal with a hope that the bidder will come back with a better offer. Sometimes that's the case. So if that's the case, that's pretty good, because obviously they want a better deal for the shareholders. So they say, oh, that's too low, why don't you come back with a better offer? But some other times, it might be just because they are trying to protect their own job. Because they know that when the company is being taken over, chances are they're going to lose their job. So many companies actually offer the management team what we call a golden parachute. So a golden parachute is a very generous payout if they lose their job as a result of a takeover. Anyway, so that's the different reasons why the management team of the target company might want to reject an offer for a takeover. There are other things that they can do. The other thing that they can have in their incorporation documents to stop a takeover from taking place, they might have supermajority, meaning that they need the majority of the approval of the shareholders for a merger to go ahead, so usually it's 80%. You have a stacker board. I kind of highlighted this already. You know, at any point in time, only 1 or 2 directors can be replaced. So if you want to replace the board of directors and essentially gain control of the company, it's going to be over a long period of time. The offer has to be at least fair price for it to be considered. So the fair price is determined using a formula, obviously, based on the market price. So it has to represent a certain premium for it to be considered. Now, if there is a predator that all of a sudden obtains a large proportion of shareholdings in the company, that might come with restricted voting right. So what it means is that they might say, if anyone obtains the obtain 20% of the share of the company. Anything beyond that come with restricted voting right. So this is to stop the predator from engaging in a proxy fight or proxy contest. They might have in place some sort of a waiting period, so any takeover that is to go ahead have to wait for a certain period of time before it can be completed. Or you can have a poison pill, which I already explained. So a poison pill allows the company to flood the market with additional shares of the company. So it has the dilution effect. It makes it a lot more difficult for the potential acquirer to obtain the amount of shares that it needs to take over the company. Once the offer has been made, a couple of things that they can do. The most thing is litigation, file a lawsuit, take them to court. Two major type of lawsuit can take place. The first one is anti-competition. Anti-competition, they just argue that as a result of the merger, there'll be less competition, therefore it's not good for the shareholders. The second type of lawsuit is anti-securities law, so the merger might violate some sort of securities law. So two major types. They might engage in some sort of asset or liability restructuring. So in terms of asset restructuring, the target company might buy assets that the acquiring company clearly doesn't want. So they make it less attractive to the acquirer. Liability restructuring, essentially same as poison pill. They might want to increase equity, having a lot more shares in the market. Or they can have the last one, which is to seek a white knight. So a white knight is a friendly acquirer, if you want. So if you don't want to be taken over by by a particular company, you might invite another company from taking over you. Then at least you know that the acquirer is friendly, and you know that you can work with one another. So there's a number of defensive tactics that might be used, when the target company wants to block a certain deal. So as I said, I've got a couple of other slides that look at the Australian regulatory framework, but they kind of regulations, so they're not very interesting. You can go and have a read. But in Australia, all merger and acquisition deals have to go through the ACCC for review. So essentially, the ACCC job is to make sure that the merger is not going to result in lessening competition, which can be hurtful to shareholders, not shareholder consumers. So you're already packing up, so I assume that is a signal that this lecture has to come to an end. I hope that you have a good break next week, and I see you back here in 2 weeks' time.